Dear students, have you thoroughly studied chapter number 5, our introduction to stocks? Well, I hope so, because now you're in for a treat, because this module, this chapter, is awesome. And it's not as tedious and detailed as chapter number 5, but it has concepts and techniques and skills that are just you won't believe how cool these are, because you are going to learn techniques that the vast majority of investors don't even know exist, and will, I believe, tilt the odds in your favor such that you will be prudent, long-term oriented investors that should thrive over the long term, assuming the world doesn't end, in which case all bets are off. So let's get started. Common stock valuation. Yeah, in other words, how much is it worth? And here is a quote from a mutual fund manager, Greg Ireland, with over 35, close to 40 years of experience. Value matters. You ignore value at your peril. So remember our discussion of growth and value, and people say, well, value's low PE and growth is high PE. That's too simplistic. Value means there's something there. There's something that is worth a value, that is worth something, that causes us to be interested in potentially investing in it. So remember, we are going to learn about value, and we are not going to ignore value, because you ignore value at your peril. Slide number 2, common stock valuation. The process by which the underlying value of a stock is established on the basis of its forecasted risk and return performance. In other words, what's it worth? At any given time, the price of a share of common stock depends on investors' expectations about the future behavior of the security. A fundamental assertion of finance holds that the value of a stock is based on the present value of its future cash flows. In other words, what's coming in the door, what income is the company earning. The worth of a company is primarily based on the earnings the company will produce in the future. But if we knew what was going to happen in the future, it would not be called the future, would it? Yeah, exactly. You getting the idea that this ain't going to be easy? Yeah, let's continue. The most fundamental influence on stock prices is the level and duration of the future growth of earnings and dividends. However, future earnings growth is not easily estimated, even by market professionals. And this is Professor Burton Malkiel, who wrote a wonderful book that you should read someday. It could be one of the first books you read. I read about stocks. I like One Up on Wall Street. A Random Walk Down Wall Street. You're going to want to read this one, because he's got a great sense of humor and playfulness, and he's also very brilliant. So you want to read this book. But he says that it has to do with the fact that a company is in business and is trying to earn money, and so the stock price is based on the future growth of those earnings and potentially dividends. But it ain't easy. So if someone were to ask you, what is the most important factor in determining the future value of a company, in a few words, you could say future earnings, or you could say future dividends. Sound like a test question? But do any of us know what is going to happen in the future? No. So is valuing stock going to be easy? No, it's not. It's not easy for the pros, let alone us armed with our little internet connection. Yes, so we're going to learn how to tilt the odds, as I say, in our favor in Chapter 6. Slide 4. Security analysis is the process of gathering and organizing information and then using it to determine the value of a share of common stock. We are looking for what is often called the intrinsic value, the underlying or inherent value of a stock as determined through security analysis. The question is, what security analysis methods or measures does one use to determine the intrinsic value of a company? Do we use future dividends, potential capital appreciation, the price-earnings ratio, the financial ratios, which we've taken a look at a couple. We're going to look at more in the next chapter. The past price performance, those are the technical analysts. The amount of risk, how do you measure risk? Value, dear students, is in the eye of the beholder. We're going to learn a few techniques, not many. There are dozens out there. But they all hinge on, not all of them, I'm sorry, but the ones that I believe you should concern yourself with, in my humble opinion, hinge on the earnings and the dividends. Yeah, exactly. In other words, the company's in business to make money. How's it doing? And what's the potential for the future? Slide number 5, fundamental analysis. What we're going to be doing in this chapter and chapter number 17, or next chapter, I know they don't go in order, is fundamental analysis. It's an examination of a firm's accounting statements and other financial and economic information to assess the economic value of a company's stock. Some of the examples of the fundamentals are the competitive position of the company. In other words, is it a Coca-Cola or Pepsi-Cola, or is it a Monster? Yeah. Growth. Monster is a company, folks, for those of you old enough like me to really not drink those sodas, those energy drinks that make you really buzzed. Used to be called Hanson's, if you can believe that. What are the growth prospects for the company and its market? What are the profit margins, the company's earnings? What assets are available? What is the company's capital structure, which is a fancy way of saying how much debt, how much equity, how much does the company own of the company, and how much debt do they owe? Simply put, the value of a stock is influenced by the performance of the company that issued the stock. Now, doesn't this make perfect sense, folks? I mean, this is just a no-brainer, isn't it? Well, not really. There are people who don't adhere to fundamental analysis. They use a type of analysis called technical analysis, which we will discuss later on. And I think they're all wet, personally. But then remember, there's chocolate and vanilla, and some people like strawberry. And I tell you my bias is right up front to get them out of the way, because when you're teaching a subject as as complicated and there's all these different schools of thoughts, you obviously bring your own biases to the table. So I tell you mine. I side with the fundamental analysts. I think that's the way to go. The technical analysts, I look at them, I read them, I kind of, there's another guy that I should be reading who's supposedly really good at this, but good at technical analysis, but So let's continue with fundamental analysis. Slide number 6, financial ratio analysis. One method of security analysis involves looking at certain financial ratio measures. Financial ratios give us a quick and easy method for comparing one company to other companies within their industry or the stock market as a whole. Now, there's a problem with financial ratios. The problem with financial ratios is that there is no single financial ratio that can adequately sum up or summarize the overall general state of affairs, the situation, the predicament, etc., that a company finds itself in. So we'll discuss these in detail in our next chapter. And in this chapter, we will use the price ratio models. The first financial ratios we will investigate will be the price ratios. And then we'll look at other financial ratios in detail in our next chapter. In our previous chapter, we looked at a few. Remember the price to earnings and the dividend yield and the dividend payout ratio. Those are all ratios. And I like to think of them like a stew, like a soup. You look at all of them at one time. You don't just pick out one and say, ooh, this is the reason. The price ratio is this. That's why I'm going to, price earnings ratio is this. That's why I'm going to buy this stock. No, it doesn't work that way. And when you eventually read The Intelligent Investor by Benjamin Graham, don't read that first, but when you eventually read that, then you're going to see that Mr. Graham was a big fan of financial ratios. He really went over them with a fine-tooth comb. But again, one does not tell you, the whole story. You have to look at all of them. Slide number 7. Now, to review, the most popular stock market statistic is the price-to-earnings ratio. And it is rather subtle, and we'll take a look at more situations with price-to-earnings as we go along. But we've already taken a look at some, right? And the most important thing to take away for now, is that the price-to-earnings ratio essentially tells you what investors believe the future prospects for the company are. Now, as I said, it's a little subtle because it doesn't always mean that. The price and the earnings are always changing, and the contextual information about the company is very important. In other words, what's going on with the company. But just at first glance, we can say, yes, people think the future for this company is, phenomenal. Or we can say, we don't think that the future is that exciting, right? So here are 4 companies that have almost nothing in common except for the fact that they all start with the letter A. Now, you might say that Apple and Amazon have a few things in common. Apple's trying to get their cloud business going, but it pales in comparison to Amazon. And Amazon's trying to sell more devices, but that pales in comparison to what the iPhone sells. But here we have Aflac, which you've heard of, right? The insurance company with the duck. AutoZone, right? The 7-Eleven of car parts company. Apple and Amazon. And so what can we glean from looking at these 4 PEs? Let's take a look. Well, Aflac is 7.6 as of September 7th. AutoZone is 15.7. Apple is 20.1. And Amazon's 154.6. Right, exactly. So which company are investors the most excited about? Amazon, right? Are they excited about Aflac? No, even though insurance companies are normally great cash cows. Insurance companies are kind of like banks. How do you know they're making money? Their doors are open. But people are not too excited about Aflac. Now, what about AutoZone? Well, that's about average. For many years, 5 to 12 to 14 was, average, and 14 to 20 was for companies that were growing, and greater than 20 was unusual. But at different times in the 1920s, 1960s, 1990s, PEs reached to the sky. And so now they're all over the map. Some companies are astronomical, some are dirt cheap. So when people say that the market is expensive, I say, well, yeah, some companies are, but Aflac and AutoZone, they don't look too expensive to me. Now, Apple is on that cusp of about 20 where things are starting to get expensive. For a long time, Apple was around 13 or 14, and now the stock has done very well. The price has risen, which drives up the price-to-earnings ratio, because remember, it's price over earnings. But still, it's not astronomical like Amazon, like Netflix, right? And some companies are just priced to perfection. Now, what happens if all of a sudden Amazon has a bad quarter, or things are different, things change? Exactly. Investors are so excited, they have bid up the price so high relative to the earnings, that if something goes wrong, the parachutes had better be very, very large. So, on the surface, without doing any other without doing any other investigation, research, which of course you must do. You can't just look at the PE. We can see that investors are not too excited about Aflac at all. Check out Ford. Oh boy, they're not very excited about Ford, and I think Ford's going to do okay in the next few years, but I don't know if I'm right. They're okay without a zone, kind of excited about Apple, and just ecstatic about Amazon. Which one do you think is the better buy? We'll know in 3 to 4 years, right? See what you're up against? Slide number 8. Okay, continuing PE, the most popular stock market statistic. Historically, a company's PE ratio was supposed to match its growth rate. If a company were growing at 20% per year, then a PE of 20 was justified. During the internet bubble, many companies had PE ratios in the hundreds. I will never forget looking down at the Quotron machine, which was the machine we used before we had the internet, but we were still using Quotron, which has been around for decades. Looking down at the Quotron machine in the brokerage firm and seeing 10,000 for the PE of eBay. And remember, we talked about our discussion of growth versus value. Growth stocks typically have high PEs, like Google. Value stocks, in this case, I guess GM, right, typically have low PEs, but that's not the old GM. This is the new GM. But remember our discussion of growth versus value? A growth stock might be a good value, and a value stock might not necessarily be a good value. Also, and this is something that Peter Lynch talks about, and some students say, well, why is that important? I don't know that it is, but it's something to think about. The PE ratio tells you how long it will take back in years, assuming no changes in earnings, but remember, everything's changing all the time, for the company to earn back its price. So if you have a PE of 3, it's going to take 3 years for the company to earn back its price. If it's a PE of 20, it's going to take 20 years. And not that that's important in and of itself, but it's something to think about, because a PE of 10,000, it's going to take 10,000 years for eBay to earn back its price. Back in, this was 1998, as I remember. Yeah, we were worried about the Y2K problem. They need to worry about the Y5K problem. What's going to happen when we go to 9,999 to the year 10? You know what? None of us are going to have to worry about that problem. Slide number 9. Price to cash flow. Well, it's the same idea, folks. We had price to earnings. Price to cash flow is basically the same idea, except instead of using your earnings, you use your cash flow. And you're probably thinking, wait a minute, how could the cash flow be different than the earnings per share? Well, there are several reasons. And if you've taken accounting, you know one of the major reasons is depreciation. Depreciation is not an actual cash expenditure. You as a company do not write out a check to depreciation. But you can use that expense to lower your earnings and hence lower your taxes. And it has to do with how the IRS, the tax code, taxes companies. And so if you've taken accounting, you know exactly what I'm talking about. If you haven't, think about it. It's not that difficult. A company is allowed to take an expense called depreciation. Now, no check is written, no money comes out of the cash tiller, it comes out of the cash drawer to pay for that, but it allows you to reduce your earnings and hence reduce your taxes. But that money is still there. And so what you will hear some people say is good quality earnings versus poor quality earnings. Huh? Well, sometimes a company might book, as they say, solid earnings, and yet their cash flow goes down. Now, how can that happen? Well, this was de rigueur. This was what you saw quite a bit in the internet mania of the late 1990s. Many companies were reporting record earnings, but at the same time their cash flow was negative. Huh? Well, one example is Lucent Technologies. Lucent Technologies was spun off from the old AT&T, and they used to be called Bell Labs and Western Electric. They make the best telephone equipment in the world. And they were selling tons of telephone equipment back in the late 90s. But they were selling them to companies that had just gotten started, were startup companies, and they didn't have $2 billion for this equipment. So instead of going to the bank, which the bank wasn't about to give them $2 billion, lend them $2 billion, they went to Lucent Technologies and said, Lucent Technologies, would you sell us this $2 billion of equipment, please? And instead of us paying you, we promise to pay you to $2 billion. We promise to pay you the $2 billion over the next 25 years or whatever. You understand? So Lucent became the bank. Yes, they booked the sales as earnings, but they didn't get the cash. They got a promissory note to pay the cash. And of course, very quickly, many of those companies just evaporated because there was no way they were going to make any earnings for several years. And you can't keep working if you don't make earnings. And then Lucent Technologies, well, they got the equipment back, but they didn't want the equipment back. It's already obsolete. So they almost went bankrupt too in the dot bomb, the crash of 2000 to 2002 in technology. Lucent almost disappeared. And I remember the stock price hit 80 cents or something like that. And I kept saying, buy it. They make the best telephone equipment in the world. Yes, but they might be gone, so don't buy it because they might be gone. And sure enough, they rebounded to like $1.60 or something like that. But still, it was a near-death experience. And then they got together with a French company called Alcatel. So it's called Lucent Alcatel now. So you understand the difference between good quality versus poor quality earnings. Slide number 10, price to sales ratio. Okay, well, what is this? Well, it's the same idea, but instead of using earnings or using cash flow, we're now using sales. We use the current sales divided by the divided into the current price. So the annual sales per share, current price divided by annual sales per share. And again, a higher price to sales ratio suggested a higher sales growth. Lower suggested a lower sales growth. These things, this one was used quite a bit during the internet mania. Why? Because many of these new companies never generated any earnings and didn't look like they were going to generate any earnings for quite some time. So they used the price to sales. Hey, well, look at their sales are growing. They're losing a ton of money, but their sales are growing. Yes. One company that did survive was Amazon.com, which is now just called Amazon. Their sales were skyrocketing, and this is the genius of Jeff Bezos, he was thinking 10 years, down the road, not just 2 or 3 years. He was saying we are going to continue to use every dime we can to grow this company, and we'll lose money for the next 4 or 5 years, but then watch out. And he was right. Now, he could have disappeared, right? Exactly. That's a dangerous game because if you keep losing money, eventually people are not going to lend you any more money to lose. But enough investors said, he's on to something. We think he's going to emerge from this. And they did. And Amazon did. And now they're rivaling Walmart and rivaling all the rest of the retail world. Slide number 11, price to book ratio. We talked a little bit about book ratio in Chapter 5. This is the accounting worth of a company. Remember, to get the book value, you take the assets minus the liabilities, and then you divide by the number of shares outstanding. Benjamin Graham in The Intelligent Investor will talk quite a bit about book value, and he was right. It's important, but it's not as important as it used to be because many companies don't need as much assets anymore. They don't need that many physical assets. They have intellectual assets. So historically, if a price to book ratio was greater than 1, then shareholders believe that the firm was creating value above and beyond the physical assets of the corporation. Well, that's just not true anymore. It's just not true. You'll have price to book values of 4 or 5. In other words, the book value might be $10, the stock price is $40 or $50. Why? Because companies are worth more intact than they are if you sold off all the assets, paid off the debts, and walked away. Think of a shoe store or a pizza shop. I like to make it simple, so look at a small company, and you look at the assets, and not that many. I mean, maybe the pizza oven is really worth a lot of money. But the fact that they're in business and generating income creates value way above what the assets are worth. So what you'll see, a price to book value of 4 or 5, and I used to ask you to get the book value in the Chapter 5 assignment, but now it's gotten really hard to do so because the only place that still lets you do it is Yahoo for free, is Yahoo, and they've destroyed their website, so it's really hard to find it. But it would be a interesting exercise for those of you who are motivated. Attempt to find the book value of the company you are in researching, and we will eventually. I'll show you a very good, excellent resource that gives you that information. Okay. Now, in the turmoil of 2008 and 9, the price to book value as a market as a whole went down to about 1.8. Now I think it's about 3 or 4. I think it's about 3 or 4, which is historically, since modern times, since like the 1960s or so, typical 3 or 4. Yeah, the price is about 3 or 4 times the book value of the company. Okay. So I burbled on now for 27 minutes. Let's see if we can use this information to predict future stock prices. And it turns out we can, just not very accurately. Slide number 12. To predict the future stock price using price ratios, we multiply a historical price ratio by the expected future value price ratio denominator. What are you talking about? Well, actually, folks, the calculation is very easy. It's very simple. It's just understanding what you're doing is the hard part. What are we doing here, folks? Let's take a look at the book example for the 7th edition. This is also in the 4th, 5th, 6th, and 7th. And you don't need the book. I said go to the library, check it out. I mean, you can't check it out. You can read it there. But in mid-2012, when the 8th edition just came out, and so we'll be switching to that eventually. But the 7th edition was revised in mid-2012. And the stock price for Intel, you've heard of them, right? They make the processors in all PCs. Not all. They have a competitor, AMD, but they're the giant. About $27, $26.98. And their earnings per share for mid-2012, that's a typo, should be mid-2012, is $2.31. And you go back 5 years. Now, whoever did this went back 5 years, and we'll show you how to do that later on, or where to get that information. And the average PE was 17.1. Now, the analysts believe that the growth rate is 7.6% for the next year. They believe that next year, a year from mid-2012, the earnings per share will have grown by 7.6%. So that $2.31 will have grown by 7.6%. So how do we do this? We take that historical PE, 17.1, we multiply it times the current earnings per share, and then we multiply that times 1 plus the growth rate to account for the 7.6% rise in the earnings per share. So the calculation is very simple. Do it. Make sure I did it right because I goofed up here. This is supposed to be 2012. Make sure I did it right. 17.1 times $2.31 times 1 plus 0.076. And notice the parentheses. You got to do the addition first. and you wind up with $42.50. So what we're saying, dear students, is if this comes to pass, if 7.6% is indeed the growth rate for the earnings for Intel, and we continue to have a PE of 17.10, then we should see the price rise to $42.50. It's that simple. Even though it sounds really complicated, it's not. We're simply taking that historical price ratio of 17.1, it's an average of the last 5 years, we're multiplying it times the current earnings per share, and then we're increasing that by the growth rate, 1 plus the growth rate, whatever we believe or the analysts tell us or whatever we think is going to happen in the future. Because remember, it's the future, and do we all know what's going to... No, we don't know what's going to happen in the future. All right, so that's it. Do it. And then there's a worksheet. There's actually 2 worksheets that you're going to do, and then there are assignments that you're going to do, and then there's an exam that you're going to do, and you know what? They're all going to look exactly the same. So make sure you do these. Contact me if you have any questions, folks. We want you to be awesome. So don't just throw up your hands and say, I don't understand. Do the calculations. You'll see the calculations are easy. And then later on, you'll go, oh, I know what I'm doing. Yeah, this is pretty straightforward. And we're going to do this 2 more times. Slide number 13. We're going to do the exact same thing, but in this case, we're going to use price to cash flow. You with me? And notice that the cash flow is more. $3.65. Well, then why would Intel's cash flow be more than their earnings? Again, depreciation. Think about it, folks. You know, Intel's a great money-making company. They sell these chips for $100, $500, the new ones for $1,000. How much does it cost them to make a chip? Cost them a couple bucks to make a chip. It's, you know, it's made out of silicon and ceramic. It's dirt. Wait a minute, Payano. Mr. Grove and all the other CEs of Intel will beg to differ with me that it cost them a couple bucks to make a chip. Yeah, it cost them the variable cost to make a chip is $2, but it cost them $1 billion to make the first one. You understand? There's a ton of research and development behind every new chip. So they will say, yeah, he's right. It cost us a couple bucks to make a chip, but he's wrong in that he's not including all the upfront costs. And what do they have to do with those upfront costs? They have to depreciate them. Excellent. So that's why the cash flow per share is more than the earnings per share. And if we go back 5 years, we find that the price to cash flow ratio over the last 5 years was 8.00. And the analyst or whoever, maybe you, maybe some other entity, is predicting that their cash flow per share will grow next year to 7%. So we do the exact same thing. We take the 5-year average of 8.00 times the current cash flow per share of $3.65, and then we multiply that times 1 plus the 7%, 1.07. Make sure you do that calculation first. That's why it's in parentheses. And we wind up with $31.24, and this is very far from our previous estimate of $42.50. What's going on here? Are you confused? If so, stop. Stop the presentation, do the calculations for this slide and the previous slide, and do them a few times, and you'll see the calculation is very simple, and then what will happen is you'll understand what you're doing. You're taking the 5-year average for the cash flow per share, or price to earnings per share, times the current cash flow per share, or current earnings per share on the previous slide, and you're multiplying it times 1 plus the growth rate. And we're going to do it again for price to sales per share. So this is slide 14. Again, the mid-2012 stock price was about 27 bucks, and their sales per share was almost $10, $9.99. Because remember, there's a lot of overhead and cost of goods sold and distribution and all the other. They had to pay the rent and all the lighting and the utilities and salaries. So there's a lot of costs involved. So their sales per share were $9.99. And going back 5 years, the price to sales ratio was 3.00. The analysts or Intel tells us, or we think, the sales per share is going to grow at 4.5%. So we take the 3.00 5-year average times the $9.99 current sales per share, multiply that times 1 plus the growth rate, 1.045, because we believe the growth rate is 4.5%. And we get $31.32, which is actually close to the price to cash flow projection, the previous slide. So do these enough times, do the worksheets, and you'll see there's answer keys, there's a commentary, folks. We want you to succeed, and you'll see that they're really not that hard. They're actually pretty darn simple. Slide 15. Reality check! Can we reasonably assume that the formulas in the previous slides will give us realistic figures? Well, for many companies, yes. For many more, no. But there are countless other factors at work, folks. As I use this analogy, I don't know if it's a good one, if it makes sense to you. There are tons of pieces of information when they try to predict the weather, most of which we do not have. So when people say, how come they said it was going to rain, it didn't rain? Because there's lots of other things going at work. There's lots of other things at work in the atmosphere, and they didn't have that data. And so for us, we're doing the same thing. We're using just one little pieces, or just a few little pieces of data, and there's a ton of other stuff going on. It's a huge machine in motion, and we're trying to analyze it as it goes by us. The major assumption of these models, which is not necessarily a good assumption for many companies, is that the price multiples will remain constant. Remember, we used an average over the last 5 years. We are using averages without taking into account the variances and the standard deviations of those averages. Do you remember the variance, the standard deviation? Remember those? It's as if you stuck your one foot in a bucket of boiling water and the other foot in a bucket of ice and said, well, on average, I'm about 70 degrees. Is it reasonable to expect predictions from these models to be accurate if the variances of the average are large? Well, obviously, no. Slide number 16. For the record, dear students, the price of Intel 1 year later in mid-2013 was around $24. Two of the predictions were 31, 32. The other one was for 42, and we were at $24. And if you go back to the 3rd, 4th, 5th, and 6th edition, you'll see that there was only one time, the 6th edition, that it actually panned out. 4 out of 5 times we were way off the map. Does not give you much confidence in the price models that we just went through, do they? Yeah, well, I'm not a big fan of them myself, but take heart. The predictions for Disney from the book were much closer to the actual prices. What's the moral of the story? A company like Intel, which is in a very volatile sector, technology, is a lot less reliable with regard to the average PE, the average price to cash flow, the average price to sales. Whereas a company like Disney, which every once in a while they have a blockbuster or a big dud that affects their earnings in a big way. But no, they're very reliable earnings. Are you with me? Yeah, you understand? Great. Now, I know there's still some confusion because it just seems too easy, but what am I doing? I don't understand. This is the typical response people have. So you're going to go back and do it again, right? Okay. And then do the first 3 problems in worksheet number 1. This is what we would do in the face-to-face class. We would now do the first 3 problems in the worksheet number 1, first 3 problems in worksheet number 2. There's a commentary, there's an answer key. Why? Because we want you to be awesome. And when we come back, ooh, are you in for a treat? Because you're going to learn a model that is one of my favorite models. The next one is in the third presentation. And you are going to see something that is most people just have no idea even exists. Yes, indeed. You are in for a serious treat. Now, before you come back, you've got to get you got to get ready, you got to exercise, you got to stretch your brain, because you're going to see something that most people I already said that, don't even know exists. See you in our second presentation when we take a look at the dividend discount models.